Welcome to the Kaiser Report. I'm Max Kaiser. Heiress, hostage, and armed robber, Patty Hearst. Granddaughter of William Randolph Hearst said of her 19-month captivity at the hands of the Symbionese Liberation Army, the SLA, quote, they call it Stockholm Syndrome and post-traumatic stress disorder. And, I had no free will. I had virtually no free will until I was separated from them for about 2 weeks, end quote. Think about that the next time you cash in your 401k or rob your savings account in the name of central banks' collective, twisted debt ideology. Are you being held hostage by credit terrorists? Are you in love with your captor? Are you suffering post-traumatic debt syndrome? Stacey?
Yes, Patty Hearst was an armed bank robber after she fell in love with her captors. Here's a picture of her. Oh, wait. No, that's you. That's with the Silver Liberation Army.
Oh, there I am, posing as Patty Hearst in this famous shot from the 1970s when men were men and the SLA rode high.
She claimed to have post-traumatic stress disorder, and post-traumatic stress follows trauma or repeated trauma, and she allegedly did suffer trauma at the hands of this radical left-wing terrorist group. And this brings me to the first headline regarding trauma. The Fed doesn't work for you. What's behind the Fed's recent interest rate hike? A desire to keep workers insecure and wages depressed. So this was written by J.W. Mason, who's an assistant professor of economics at the City University of New York, CUNY. And he talks about something that this is Fed policy, is to keep intentionally American workers traumatized in order to keep inflation low. And he points to two things. First of all, he talks to Bob Woodward, wrote a book in which he quotes about Alan Greenspan. He says, the old belief held that with such low unemployment rate, workers would have the upper hand and demand higher wages. Yet the data in the late 1990s showed that wages weren't rising that much. It was one of the central economic mysteries of the time. Greenspan hypothesized at one point to colleagues within the Fed about, quote, the traumatized worker, someone who felt job insecurity in the changing economy and so is accepting smaller wage increases. And then he goes on to actually show some of the quotes from actual Alan Greenspan speaking in Congress in testimony in 1997, praising basically the traumatized worker as a reason for the golden, miracle economy of the late 1990s.
So here you have a professor indicating something we've talked about before, that the central bank uses interest rates as a bludgeon, as a cudgel, as a tool, as an instrument of coercion, of terror.
Yeah, they're actually trying to traumatize the worker. That's their intent. And for example, in Alan Greenspan's testimony to Congress, it says, testifying before Congress in 1997, Greenspan attributed the extraordinary and exceptional performance of the 90s economy to, quote, a heightened sense of job insecurity among workers, and as a consequence, subdued wages. And over, once FOMC Fed minutes are released 5 years afterward, you see, looking back, there's dozens and dozens of examples of Federal Reserve members actually wanting to achieve a traumatized worker.
So it's not an economic policy. This is a policy of financial torture.
Yes.
And with the objective of scaring workers into being traumatized into contributing to an economy that was based on the mass movement of savings from the workers and the savers, Americans, into the accounts of speculators on Wall Street with the conduit assistance of the Federal Reserve Bank. And this is a great point. This needs to be understood. When you hear economists speak about the policies of the Federal Reserve Bank or those of the Treasury Department or those in Washington making economic policy, they couch it in terms of Keynesianism or some other school of economics. As we've said on this show, and as this professor points out clearly, interest rate apartheid or interest rate terrorism is meant to destabilize and to torture and to abuse people. And what we've seen are complete loss of wages, complete loss of financial sovereignty, a complete loss of savings account. We've seen wealth and income gaps skyrocket. We've seen social unrest, using the tool of interest rates as a tool of torture, as this professor clearly points out. Here in the UK, also, Bank of England does the exact same thing. This is my problem with the left in the UK, is that they refuse to take on interest rates as a a mechanism to force.
But here we see, the actual economists at the central banks are intentionally using interest rates to bludgeon workers, to keep workers from ever asking for wage increases. So they're actually using it as a tool to control wages, and yet, as you're saying, the left wing doesn't ever bring that up.
The stated purpose is that they're trying to bring back inflation, but we know now after years that this lax economic policy, low interest rates, and quantitative easing programs actually cause the deflation that is causing the disparity and the social unrest, and for many people to feel as though they are suffering from post-traumatic stress disorder.
Yeah.
So they watch CNBC and they see those happy talking torture people like Joe Scarborough is another guy who gets on TV every day and tortures people with his insanity and support of the idiocy and mendacity of the central bank.
Anyway, he's a local American presenter. Nobody knows him internationally, but he is a local presenter. But let's talk about this Fed policy of torture and how it has actually worked in terms of traumatizing the worker. Because now this professor here at CUNY, he thinks that the reason why the Fed raised rates, despite the fact that inflation is low, is that their manipulated rates show that unemployment rate is down below 5%. So they're afraid that workers might start to ask for wage increases. So they want to make sure that the income as a share of GDP stays as low as it is. They want capital to always be winning. So let's look at how much they have succeeded. Why Americans can't stop working. The poor can't afford to, and the rich are enjoying themselves. So this is an article talking about Keynes, John Maynard Keynes in the 1930s, and what he saw was that productivity would increase so much that in fact it would increase by 4 to 8 times over the next 100 years, and we're now at that point, or close to that point. And he saw that the problem in the future, and this is back in the 1930s, the problem in the future would be that we would have too much free time. And what would we do to fill our time? Well, that never happened because, as Benjamin Friedman, who in a new paper of the Journal of Evolutionary Economics points out, that by 2029, Americans will have octupled its labor productivity, just as Keynes had predicted. But he says, according to Friedman, between 1947 and 1973, the average hourly wage for non-supervisory workers in private industries other than agriculture, restated in 2013 dollars, nearly doubled from $12.27 to $21.23, an average growth rate of 2.1% per annum. But by 2013, the average hourly wage was only $20.13, a 5% fall from the 1973 level. For most people then, the magic of increasing productivity stopped working around 1973, and they had to keep working just as much in order to maintain their standard of living. So from 1973, of course it was from 1971, August 1971, when the U.S. went off the gold standard and the rest of the world followed, and it was on a global dollar standard, that the Fed could have the ultimate weapons in controlling the global worker population, because there was nothing, they didn't need any real wealth, any gold behind their policies, and they could just abuse their population at will.
You don't need workers generating taxable income to pay off the debts when you can just go to Wall Street and print the money, or go to Washington at the central bank and print the money. So those at the very top of the socioeconomic scale don't need workers. They don't need people toiling for an hourly wage, because when they need money, they just go to the Fed and they give the money to them for free. So everyone else who's not got that open window of borrowing at 0% interest from the Fed is faced with the fact that their hourly wage in real terms has gone sideways to down for 30 years. And you can look at that and say, well, the productivity is higher. But then again, you could also look at a penitentiary and say the productivity at this prison is extremely high because these people are only getting 50 cents an hour. And look at all the output they're generating.
All the productivity gains went to the capital class, the class on whom's behalf the central banks work. So they were able to abuse them, the worker population, and hand it. We've showed that chart over and over, where from 1972-73, productivity continues to increase and wage earners, their incomes go down. So on top of this, we also have now this new, even more precarious population where everybody's on either 0-hour contracts or they're Uberized. Everything's Uberized. Is like you're on demand. Literally, you have no sort of leisure time at all that Keynes would have predicted. It's all like desperate looking for work. And this is causing even more trauma within the economy. Here's a headline from Australia. high-rise residents fight sharing economy over reports of pop-up brothels and all-night parties. The growth of short-term stays in high-rise apartments facilitated by companies like Stays, Airbnb, and other companies is seeing permanent residents living through all-night parties, pop-up brothels, and building damage caused by weekend renters. So this is in Melbourne. They're looking at it. They talk to people like one guy who, all those nice new apartment buildings going up, as you see behind us, you know, they're empty, but people are letting them out on Airbnb, and those who want to have a permanent, stable residence, they're being abused by pop-up brothels, drug deals, parties, like all sort of rampages going on next door, and there's no recourse. There's nobody to call. You tried calling Airbnb. There's no way to get in touch with any of these people, or, you know, it's trauma throughout the economy.
Well, this is a trend I've noted before, is that you have the two major trends merging. One is the subsistence work that is being ladled out to Uber drivers and other types of on-demand work meets the 24-hour online reality of our connected world, which leads to what I call the insectualization, based on the word insect. So, you know, when the queen bee of the bee colony is in need, the drones, you know, respond. So if there's a pop-up brothel in Sydney somewhere, then the drone male teenagers will respond insectually because of their the pharaoh memes that are popping out of their iPhones. They simply gravitate toward the psychology of it is that we're actually entering a post-human world. We're entering into a combination of an insect human.
Yeah, but we're a traumatized world, the traumatized saver, the traumatized worker, the traumatized population, the traumatized citizen of a country run by central bankers, and we see that over and over. And in order to stay on the side of the SLA, in order to stay on the side of the Federal Liberation Army, well, you have to get into debt. You have to become one of these people who, you have to own the car to rent, you have to own the house to rent, and at least 40% of the apartments in many blocks are investment owned in these new blocks. And they're saying a lot of people have loans to pay back. So many people are making good money out of getting groups of apartment owners to act as quasi-hotel. And it's causing a lot of problems to long-term residents who actually like living here. And one of the people who rents out dozens of his apartments that end up terrorizing his neighbors, he says, well, go live out in the countryside. Just get out of this society, go live somewhere else.
Metamorphosis. Become a cockroach. All right, we got to go. Yeah, stay tuned for the second half. A whole lot more. Welcome back to the Kaiser Report. I'm Max Kaiser. Time now to return to Lee Adler. He's a publisher of the Wall Street Examiner. Lee, welcome back.
Thank you.
All right, so Lee, in our first segment, we were talking about the role of the primary dealers,
right,
which I think is a very interesting topic and underserved by the financial press. And talking about the primary dealers, they are the conduit where the central banks are interacting with policy in terms of making credit more available, less available, and pari passu with that concept, to use a banking term that I haven't used since I was a stockbroker myself 25 years ago. Former Dallas Fed President Richard Fisher recently said that the Fed front-loaded the market. Okay, so here's an exact example of what we're talking about. Here's a former Fed official. He's indicating the verbiage. He front-loaded. So once again, the Fed, in other words, pushed a lot of money into these primary dealers, who then made that cash available to the stock market to create a speculative bubble, right?
Exactly. Well, you know, this is not a surprise. In November 2010, when Ben Bernanke wrote his Washington Post editorial justifying QE2, he basically laid out the whole basis for the trickle-down theory, and that was that that QE would cause stock prices to rise. Now, he didn't get into the mechanism of how that was going to happen, but basically he said, this is what's going to happen, and then everybody's going to be happy, making more money, and there'll be more confidence and more spending, and the economy will grow. Well, of course, the trickle-down pooled at the top, but the Fed did pump the cash into the markets. Now, how does that happen? There's only one conduit of monetary policy. The Fed trades every day with these primary dealers. It's a trading operation. So what is the business of the primary dealers? It's to trade. So, the Fed is purchasing securities from the primary dealers. They're being cashed out day in, day out, and this cash is building up in their accounts. So what they do is they go and buy more securities. They bid the prices up. They get the public all excited and all lathered up, and the public piles on, and prices just keep rising. As long as the central banks are pumping more money into these primary dealers, they're going to trade these markets higher.
Right. So let's say a bank like J.P. Morgan, if they want cash, the Fed is willing to buy from them for cash some securities that they create. So J.P. Morgan creates a security.
Well, they're buying treasuries.
They sell it to the Federal Reserve Bank for cash.
Right.
Now they have cash, and then that cash is lent out to speculators who are bidding the price of stocks higher.
That adds to it. But the fundamental first step is that the primary dealers are trading firms. So as soon as the Fed cashes them out, they say, oh, well, what are we going to do with this cash? And as I said, their favorite instrument for manipulating the public, of course, they're going to buy more treasuries every week. But and we've had this massive treasury bubble.
But the treasuries are printed over at the Treasury.
Yeah, but then these dealers buy, actually supply the cash that the Fed supplied to them the week before. The Fed bought the old Treasury issues. The dealers have the cash. Then they hand in the next week they buy the next issuance of Treasuries.
Right, but that's an important component in this
part of the whole
cycle. In the circles, you have the Treasury. They're creating government securities, and then these are being bought back and forth. To either the Federal Reserve is buying these for cash to liquefy banks, or they're selling them to drain their balance sheet.
They haven't done that in a long time.
And they haven't done that in many years. They have more than $4.5 trillion now of stuff on their books that if the value of treasuries were to drop by even 2%, that means the Federal Reserve Bank, by technical analysis, by all intents, is bankrupt.
Almost, except that they also hold gold at $42 an ounce, so they're undervaluing their gold. And ultimately, the Fed has a call on the American people. So through they can raise capital, and they don't really need capital to operate. But one of the things that the Fed
What do you mean they have a call on the American people? They can just print money.
Well, yeah, they can print money, and if they run short of funds, they can go to Congress and say we need more operating funds, we need more capital. Just as Congress just decided to grab some $19 billion of the Fed's capital to replace highways and bridges in the United States. Congress can ultimately rein in the Fed, but they've decided not to do that.
Right, by looking at how they, for example, the deposits at the Fed get an interest, and they can say, well, that is applicable or not applicable. They can look at what's going on there, and they can grab money if they're. But here's Lee. Let me posit something to you because it's a problem. Now, what we're describing here is free market capitalism, American style. The capital is circulated, and the idea is you create growth, and that growth creates taxes, and those taxes can keep the government going and pay off the interest on the debt, right? And that's kind of like the underlying principle. But we have something called moral hazard, where if banks are doing bad things, like a J.P. Morgan, J.P. Morgan is caught dozens of times committing fraud, dozens of times criminal liability, which are only met with a deferred prosecution, or they're slapped with a civil suit. But in other words, here's my question. When the central bank decides that the economy needs more liquidity, and you have actors like J.P. Morgan, Goldman Sachs, Citibank, Wells Fargo in this country, in the United States, and they're recidivist, law-breaking scoundrels. All you're doing is you're giving them more money to commit more fraud.
Right.
Is that a fair statement?
Yeah, absolutely. It's a financial mafia. The banks are really, but it's legal. It's legal theft what they're doing. They're
they make the laws.
Yeah, exactly.
ISIS thinks that what they do is legal because it's per their laws.
Right.
Jamie Dimon thinks that what he does is legal because he wrote the laws.
There's a lot of illegality too that, as you said, doesn't get prosecuted because only the organization or the corporation is committing these illegal acts, but there's no people doing them, obviously.
Right, or they crash the market.
Yeah.
How many times, if I said to you that whenever the banks are getting close to being prosecuted for crimes, they simply crash the market.
That's a good point. Yeah, I hadn't thought of that. That's a very good point. But at some time,
We saw that in 2008. Remember, they balked at TARP, 800 billion or whatever it was that they got, and they said, okay, they crashed the market. Then they went back into the back room the next day and they passed TARP.
Yeah, but the banks have a certain degree of control, but eventually events spiral out of their control.
And that's the point you think we're at now?
We're not quite there yet, but we are heading there again. And this time, I think it could be even bigger than the last time. I think the Fed has used up its credibility bullets. People are looking around now and seeing, hey, this thing is starting to crumble after 6 or 7 or 8 years of central bank intervention, and suddenly everything looks very shaky. I think there's going to be a crisis of confidence down the road a bit, but the doubts are now creeping into the market. You're seeing it in the market action with the sell-off we've had the last few days, and I think it'll get worse.
Well, people, including this fellow Fisher, are saying that it's tied to China, and the China fears are overblown. Is that correct?
Well, I'm definitely not an expert on China. I only know what I read from our friends, and I don't think that's correct. No, I think China's in trouble.
Is it correct to say that their place in the global economy is not that important when it comes to financial markets?
That I would not say is correct.
No, I mean, it's like saying, well, Lehman Brothers is only one bank.
Yeah.
How could the collapse of Lehman Brothers cause a global catastrophe? Because they're all interconnected.
Yeah,
So to say that
absolutely.
the China market going down won't affect us is again, financial jihadism. It's this belief that the laws of Wall Street somehow are above the laws of nature and the laws of society.
China's going to withdraw its capital from the rest of the world. I mean, that might be a slow process, but there's going to be liquidation, and that could be I see this as the beginning of a real secular bear market, not just a cyclical bear market, but something that's going to go on and on and on in waves. And of course, you'll have some bull market periods interspersed with that, but I think we may have seen the top to end all tops here.
These China and Russia have been buying a lot of gold. You follow gold. I know you've been cautious on gold for the years now. You haven't been a perma bull. You've been cautious. But I see from your writings over there at the Wall Street Examiner that you're starting to kind of look at gold a little bit now, and you start to see technically, from a technical perspective, it seems to be gathering some good traction.
There looks to be on the charts that there is some base building going on, and they've made some tentative steps. There are some key levels that it needs to get past, and there's still quite a ceiling overhead that they need to work their way through. But we're starting to see the beginning signs of something that could be a very major turn. Eventually, as confidence in the financial markets recedes, obviously gold comes to the fore again as a safe haven and a store of wealth.
The two trades that seem to be mutually kind of exclusive are gold and the U.S. dollar. So are we also seeing kind of a topping in the dollar or no?
Not yet, and I'm not necessarily sure that they are opposed to one another.
Okay.
I think they possibly the dollar and gold could actually appreciate together for a while. I know that sounds counterintuitive, but as a safe haven, the dollar is still seen as a safe haven, but the dollar is also in a short squeeze. So these are the cross currents that are going to make it difficult to hold gold. I think you're going to see a lot of up and down volatility.
The total
there.
gold market around the world is worth maybe $7 trillion, $7.5 trillion, and the total dollar market is worth hundreds of trillions.
Right.
So you could see both go up, and even a 1% or 2% of money that would have gone into the dollar going into gold, that could double the price of gold.
Absolutely. Yeah,
if the world suddenly thought, if Mrs. Watanabe, the famous Japanese housewife who on the margins has driven much of price action in the global bond market for years, if she decided suddenly en masse that, maybe gold looks good here,
right.
You could see a 1%.
It wouldn't take much to move the gold market.
Yeah. Well, maybe. Okay. So we got about a minute left or so. Now, hundreds of billions of dollars have been spent on share buybacks. So again, using this we've been talking about the primary dealers and the central banks, they make money cheap. Corporations, instead of spending the money to build capital expenditures, instead of building out more infrastructure, hiring people, brand development, they just use the money to buy back their own stock to make their earnings per share look better than they would be ordinarily. Is that game about over?
Oh, I would think so. And it was easy money for them. They're buying back the options that they just issued to their own executives, and so that was a real game of hey, let's take the money while we can. So they did that. I think I think that we've seen the end of the so-called secular bull market, and we're going to go into a period where there are waves of liquidation, and some of these games are going to be cut back, and we're going to find who's not wearing any clothes financially. I think in 2016, it's going to be a year where we find out who's wearing clothes and who isn't.
All right, so finally, your work at the Wall Street Examiner, you're saying, the theme is the last Ponzi game standing is closed. So this would be the stock market.
Yeah, the U.S. markets in general, the Treasury market and the stock market, are the last Ponzi game standing. Some would argue that here in London might be the last Ponzi game standing, and I'm not that familiar with it. But
well,
yeah,
they have the least regulated markets here.
Yeah. So they get away with a little bit
they get
more.
away with the most.
Yeah. Okay. But yeah, I think we're in a secular turn here where the doubts and the confidence that had built up in the central banks, I think, is beginning to wane, and that could lead to a huge crisis in the next year or so.
Okay, Lee Adler, thanks so much for being on the Kaiser Report.
Thank you, Max.
That's going to do it for this episode of the Kaiser Report with me, Max Kaiser, and Stacey Herbert. I'd like to thank our guest, Lee Adler of the Wall Street Examiner. If you'd like to get in touch with us, tweet us at Kaiser Report. Until next time, bye, y'all.